Hey everyone, welcome back to another special edition of Crypto Hour. Today I have special guest Lucas Nuzzi, who is the head of R&D at Coinmetrics, joining us from the United States. But before I introduce him, don't forget to like this video, subscribe to our channel, share with friends, and activate that notification bell so that you don't miss another episode. All right, Lucas Nuzzi, how are you today?
Pretty good, Marwan. Thanks for having me. It's a pleasure to be here.
Thank you so much. And how's the weather where you are now? You're in New York? You're in Massachusetts?
No, I'm actually in Michigan, in the state of
Michigan.
Michigan.
Mm-hmm.
It's kind of in the middle of the U.S., but it's a lot warmer than about 4 months ago. It snows quite a bit here, but it's pretty good. How's the weather in São Paulo? Not as
It's
warm,
actually
I think.
not as warm. It's pretty much the beginning of winter, so it's getting
Yeah,
pretty cold. I
Brazilian
mean,
winter is not too bad.
yeah, I really can't complain considering I lived in Canada most of my life. So, you know, coldest capital in the world, can't complain.
Absolutely.
So, so Lucas, tell us about yourself. Tell us about your educational background, as well as your professional career, and what led you to your journey in cryptocurrency today.
Yeah, absolutely. So I've been working in this industry for quite some time, doing different consulting gigs and building companies in industry. I'm Brazilian, born and raised in Brazil. Moved to New
Nice.
York in my teens to study comp sci and economics,
Hmm.
and came across Bitcoin while in college. That was back in 2012. It was the same year where there was a new standard that came out on storing your bitcoins more securely with
Mm-hmm.
so-called multi-sigs. So
Multi-sigs.
yeah, it's I highly recommend if you're thinking about securing your own assets to use this
Mm-hmm.
technology. But it was very new back in 2012. So started looking into it. Uh, was a really great learning experience. Really focused the majority of my time in college
Mm-hmm.
to Bitcoin at the time, um, and the custody of assets became a big part of my work life as a consultant. Worked with a couple of
Mm-hmm.
companies in Brazil and New York uh, that wanted to better secure their assets. It was at the time uh, pretty much focused on how can you use Bitcoin for payments.
Mm-hmm.
The use cases were not really clear back then, but
Right.
there was a lot of interest. There were a lot of ATMs that were being bootstrapped and ATM networks that were taking crypto, um, and saw ups and downs of the market up until late 2016 that things started getting a little bit better. I was in the founding teams of DAR, which is the first sell side research firm focused on crypto assets back in 2017, as well as a custodian called the ACC that was doing more like institutional custody for
Mm-hmm.
funds. Um, and the common denominator of my career has been really on chain data, network data. How are these blockchains performing from a security perspective? That's how I focus my career now. But joined Coinmetrics in 2020, early 2020, to build new products on the on-chain side, expand the set of metrics that are covered, and obviously Nelogica and Vector as a client, collaborating with a lot of you guys on how to use on-chain on a day-to-day as an investor, as a trader. So it's been a pretty long but fun journey.
That's excellent. That's excellent. So you have some very sophisticated work experience, great education. So we're really glad to have you here today. It's a pleasure.
Likewise, yeah.
So Lucas, can you tell us a bit more about what kind of metrics Coinmetrics works with and provides for the Vector platform?
Yeah, so we produce a lot of metrics that focus on different corners of
Mm-hmm.
the crypto economy, right? So we have metrics that are very specific to Bitcoin, where there are things like mining taking place. We have
Mm-hmm.
metrics that are specific to DeFi. It's really about what are you trying to measure on chain. And the
Mm-hmm.
beauty of the blockchain is that things are very transparent. You can have
Right.
access to all of the financial interactions between participants, but it's
Mm-hmm.
hard to access that information if you're just running the blockchain yourself, right? If you're running a node in that network, it's not as simple to see that information. So the value that we bring to Vector and other clients is we're consuming all that data, producing metrics for this data, and
Mm-hmm.
enabling people to just have better access to that information and understand, for
Right.
example, very basic things like how many transactions happened in Bitcoin yesterday relative to Ethereum. So those are really that's really the focus of my side of Coinmetrics. We also have a big
Mm-hmm.
market data offering.
Right.
So you have these blockchains where addresses are changing and you have entities sending funds to each other. You
Mm-hmm.
also have the markets where those assets are being traded, centralized markets, where a user can exchange their Ethereum for Bitcoin or the other way around.
Mm-hmm.
But you can see on-chain operations leading up to that and after that exchange has happened. And you can kind of contextualize where we are in the overall market. It's one of our main goals.
Very cool. Very cool. And so, would you guys focus more on the institutional side, the CXs versus the DEXs?
We do both. In order for
Both.
you to get a pretty good idea of even things like volume, right? Which, in traditional finance, it's really easy to determine. In crypto, it's hard because not only you have hundreds of exchanges, really centralized exchanges where assets are being traded. Now you have decentralized exchanges like Uniswap, SushiSwap, etc.,
Yeah.
that are making a
So
lot
many.
of volume.
Mm-hmm.
So you need to know a little bit of both in order for you to get a complete picture. And this is where we come in, right? We have both data on both of them, which enables you to understand, what is the volume of Ether as an aggregate asset across all of these different platforms in an aggregated way.
Very cool. Very cool. And in terms of volume, are you seeing more volume these days from centralized exchanges or from decentralized exchanges?
That's a great question. So there's been a big change in how users actually interact with the blockchain. If you
Mm-hmm.
look at the rise of Uniswap as a new platform, uh,
Mm-hmm.
there were times where there was more volume taking place in Uniswap over the course of last year and certainly this year
Mm-hmm.
relative to other centralized exchanges like FTX and Coinbase and all the others.
Mm-hmm.
So it is like a really new way of interacting with these markets. Obviously, it's not as ideal as trading on a centralized exchange from a user perspective. These decentralized exchanges, they don't have sometimes the best pricing, the best accessibility. They're very primitive in how they're structured, but
Mm-hmm.
a lot of users, especially on the retail side, see these exchanges as a way to attain exposure to an asset that might not be listed on a centralized exchange, an asset that might be brand new, and they're used in that fashion, right? There's really it's the wild west of financial markets, so anyone can list any asset there. Anyone can post a new market. It's really open in that fashion. So there are
Mm-hmm.
some use cases where that's doing better than centralized exchanges, but certainly not when it comes to user experience, right? Holding your own funds and trading on these dexes can be pretty complicated and potentially unsafe at times.
Interesting, very interesting. And on that point of security, would you say that centralized exchanges are more reliable or safer to conduct transactions in general?
In general, yes, you really need to understand the exchange that you're dealing with, right? And
Mm-hmm.
understand their disclosures, the assets that they trade beyond the assets that you want to actually exchange. Honestly, the best way really of using these exchanges is to execute your orders and still have funds that for long-term investment purposes are in your what's called a cold wallet, right? An actual hardware wallet that you went through the effort of understanding how that works, and which is, it can be pretty cumbersome, but you're storing those yourself, because we're seeing this now in the market. Like, the market has contracted quite considerably, right? We've seen this massive outflow of liquidity really from the market, and it poses some questions on exchange's abilities to meet all their obligations, right? Whether or not they're solvent. And you as a user, if an exchange out of nowhere decides to pause their withdrawals, it's a really scary feeling, because you don't know if they're solvent, if they can actually meet all their obligations. So there's some concerns around that with the situation with Celsius earlier this week, which is a project that provided loans and really leveraged crypto assets users' balance across various DeFi platforms. Celsius users are kind of in the dark right now. They don't know if they're going to be able to make all their obligations and withdraw from the exchange. So dealing with exchanges can be cumbersome. If you're operating on various exchanges and you've done good vetting and you understand that those are quality exchanges, obviously the likelihood of these exchanges to go down is a lot lower, right? These exchanges might be very well capitalized and might have stronger risk management policies to the point where what happened to Celsius might not be as applicable to them. But being careful with the exchanges that you interact with is really important.
Absolutely. Very important. Very important. I totally agree with you on that one. And as a Vector user yourself, what would you say are the most important metrics that we should be looking for, especially when analyzing on-chain data?
Yeah, there are several metrics that I use on a daily basis to understand market direction, right? Some metrics are very specific, again, to understand, what is actually taking place across all of the different entities that might be interacting with the blockchain. Are there signals that you can derive from that data that showcase that people are maybe feeling bearish, maybe feeling bullish? So there are several metrics that I use to actually better understand market direction and the fundamentals really of an asset. I'd be happy to share my screen and walk through some of these metrics. Maybe give you some background on the first one that I'd like to share. Would be a good starting point.
Absolutely, that'd be awesome. Yeah, please go ahead.
Yeah, so we're just talking about exchanges, right? Exchanges, the centralized exchanges as well as the centralized exchanges, they work on the basis of a handful of addresses, really, that is receiving liquidity from one asset and is sending liquidity either from that same asset or a different asset, right? So exchanges are really middlemen between buyers and sellers. And there are ways that you can actually see how people are interacting with these exchanges on-chain. Exchanges, they, even if you as a user, you don't have a blockchain address, if you're buying Bitcoin from that exchange and there are several users that are buying Bitcoin from the exchange, guess what? That exchange is actually going to have to go into the market, buy more Bitcoins to actually reflect the increase in deposits, maybe in US dollars or HAL or whatever currency it's being used. So we can see when exchanges are doing that. We can see when users are depositing into the exchanges and when users are withdrawing from the exchanges. So one of the Coinmetrics data points that is in Vector that's really interesting are exchanges inflow and outflow metrics that show exactly that. So let me go ahead and share my screen and I can show you guys what these metrics might be telling us, if that's okay.
Please do.
So in in this light blue here is the price of Bitcoin, right? Obviously, there's been a pretty severe contraction over the past quarter or so. And what you see here in yellow, this is the exchange deposits metric. And it's depicted in USD terms. So it's really the number of USD that was deposited into an exchange a given day. And it's an interesting metric because it showcases the intent of some users that are leveraging these exchanges. What do I mean by that? If you have a wallet, if you have, for example, a long-term investment wallet where you're storing all your Bitcoins, what would be the conditions where you deposit those funds into the exchange? You would have to sell, right? If you're depositing something into the exchange and the flows are going into the exchange, you're going to sell that. It's the operation before you sell it. So if you have a ledger or trezor with your Bitcoin in it, you're gonna move that Bitcoin to the exchange's address and you're gonna exchange that Bitcoin for USD. So flows into the exchange, they can be interpreted as a bearish signal. When they go up, there is more demand for stability, for stable coins or cash. And that's exactly what happened when Bitcoin was flirting with 30,000. Users after the decrease here from 40 to 30, the last leg, this was a really interesting confirmation that there's a lot of bearish sentiment in the market. So and prices after this ticked continue to go down up until now, where it's reached 22,000. So really interesting metric to depict how users are interacting with these exchanges and what is their ultimate market directional feeling, right? Is it bullish or is it bearish? The ins, the deposits, they're bearish, right? Because you are effectively sending funds to an exchange that you likely sell. But the ins, or excuse me, the outs, they're bullish signals. So if we want to see the out metric, and maybe here we can zoom out a little bit. Outs, they tend to spike up before price appreciation because there are a lot of users that don't expect actually having to sell those funds. So the market interprets this metric of flows out as a bullish metric because if you're withdrawing from the exchange, fundamentally you might be storing those funds in a cold wallet for long-term storage, and you don't have liquidity that is, or there's not an expectation that you have to deploy that capital anytime soon. So you're more willing to pay the network fees to draw that from the exchange and put it in your pocket and just leave it there. So two really interesting indicators to showcase, what is the sentiment of the market as a whole. In the background at Coinmetrics, we are aggregating all the addresses that belong to all the major exchanges. And this is an aggregate metric. So it's adding up all the flow going into all the major exchanges, really, Binance, BitMEX, we have, and you can look at some of the documentation to see the full coverage, but it's a really complete coverage of the exchanges operating in this market. So those two metrics are important in that sense, where it's an aggregate view of the market that requires the level of transparency that blockchains offer to you.
Very interesting, very interesting. So just to recap, so the outflow is a bullish signal using this chart, and the inflow is a bearish signal in general.
Yeah, generally speaking, those two are interpreted that way. They the interesting thing about it is that they reflect something that's fundamental, right? A behavior that is fundamental. If you're sending funds to an exchange, it's very likely that you're going to sell those funds. That's the impetus for sending funds to the exchange. If you're if you're pulling it out, that means that you're likely going to hold those funds in the long run because you're willing to pay transaction fees and everything to actually move that into a wallet outside of the exchange. So that's a bullish signal.
Kind of got to think backwards with the term in and out.
Exactly. Yeah. Yeah. It's not super intuitive, but at least like there's this strong fundamental explanation behind the actual event, and historically has been a really interesting indicator of bullishness or bearishness sentiment in the market.
Very cool. Very cool.
The other metric that I use quite frequently to understand the market dynamics is a metric called MVRV, and I'll pull this up.
To realized value.
Exactly, yeah. So MVRV is a really powerful metric, and people tend to overlook it because it's one of those on-chain metrics that has been around for a really long time. It's not like the flashiest metric that you can think of, but it is a really interesting leading indicator of frothiness, of when market participants are feeling maybe too confident, more confident that they should. And the fundamental calculation of this metric is market value. In this case, it's market cap, right? The units of supply that exist of this currency multiplied by the price of the currency, you get market cap, divided by a metric that we created at Coinmetrics called realized cap. And realized cap is the value that's actually being transacted on chain, multiplied by the price of that, which accounts for the price where it last moved. So a good way of thinking about realized cap is almost like a cost basis. It's an analogy that our clients find very intuitive because if you have a cost for that balance that's moving on chain, you can see whether or not that balance is, in profit or at loss. So dividing the two, you can kind of see when the valuations make it such that all of the market participants that are transacting on chain are feeling very rich, which it's a pretty good indication that the market has reached a top potentially. And there are two key thresholds with MVRV of historical importance, meaning that historically they've been accurate signals of tops and bottoms. A signal for the top tends to be around 3. If it's at 3 or flirting with 3, it's a pretty good sign of frothiness, historically speaking. And then the other threshold is 1. So if it's below 1, that it's a good indication of capitulation, meaning all the market participants are suffering essentially. MVRV right now is below 1. It's at 0.96, right? It did cross 3 in the weeks leading up to the all-time high. Interestingly, when it reached nearly $70,000. Similarly, in the previous sub-cycle where it made the first all-time high of 60, it also signaled a lot more strongly at the time because everyone's cost basis at this time was very low, right? It was the first run up, and it started peaking at around January, a couple of months before it actually reached the local top of that mini cycle. So really important metric. The way that people usually interpret these metrics is if it's above 3, you might not be a buyer, right? You might be slowly winding down a position.
Mm-hmm.
If it's under one, you will be effectively, dollar cost averaging, actually deploying funds into the market. So this metric, it's super simple. It's been around for a while. It's been very accurate. It has a really good track record, but it's often overlooked. And I think it's one of the most powerful metrics on chain because it gives you a sense of how rich are people feeling effectively, and some good indication of when to get into the market and out of the market using this kind of fundamental indicator.
Very interesting. So just to recap, if it's over 3, basically the asset is overvalued, right? And it's probably a sell signal. And when it's below 1, it's undervalued, so it would make a good buy signal. But you did mention dollar cost averaging, and why, just out of curiosity, why would you do dollar cost averaging entering the market if it's under 1 versus putting in a large sum of money all at once?
Yeah, so order sizing is really important for every new investor to understand. It's really difficult, especially in crypto assets where you have multiple factors really impacting the market. This existing contraction was really predicated by other macro factors, right? That had a spillover effect across all markets, really. I think Q1 was the first time in history where everything underperformed, including the non-cyclical stocks and commodities. But in the context of crypto, it's really difficult to find what is the top and what is the bottom. So the best thing you can do is actually deploy orders strategically when you're close, or when your indicators or your model shows that you're close to those critical thresholds. So when you're flirting with 3, you know that the network as a whole has crossed this point of frothiness, and it is a good sign that an all-time high might be reached pretty soon. So it's better off for you to unwind that position gradually so that your realized price accounts for the volatility of the metric itself. Similarly, under 1 is a pretty good indication, especially when you have a severe drop like this, that the market is experiencing panic, and you want to decrease your exposure to, or excuse me, you want to increase your exposure to it because everyone else is capitulating. And you want to do that gradually, because you might then get to a pretty average price that's optimal, as opposed to maybe entering now at 22K is all at once is not optimal if it goes down to 15, right? And mvrv goes down to 0.5 or 0.6. That would entail, that there's more contraction. So it's better for you over the next 3 months to deploy capital gradually as you're buying into the trend, and really think long term, because these cycles, as you can see, like the time series here, is going back to 2019, and there were 2 cycles that were compounded together within this time frame.
Very cool. Very interesting information there. Thank you so much, Lucas.
Yeah, the other indicator that I use, and it's an interesting indicator of the, again, sentiment of all the entities that are interacting with the blockchain, and it's a metric that we call revived supply. And revived supply is really supply that was not in the market over a time window that has been effectively brought back into the market. So I'm going to pull it up. And a really interesting one is 1 year as a time frame. because it showcases when holders that have been holding for at least 1 year get into the market. And as you can see, like it spikes a lot because at times these holders are whales. So they're really focusing on, or they're really just deploying a lot of capital at first. Whales are not, whales have an impact in the market, but they might mistime things as well. There are humans behind those large balances. But it has been an interesting indicator because if you see here, when you have like these local tops and bottoms where 1 year active supply goes up, it's a pretty good indication that holders are coming back in the market. There's going to be an increase in volume, and it has been an indicator of kind of short-term volatility, more than anything else. Short-term volatility, because those funds are going to be deployed in some way. What this metric doesn't tell you is how, right? Like what is it's a lot less explicit than exchange deposits, because it doesn't tell you, if they're going to sell those funds. It just simply showcases that supply has been brought back into the market. And the reason why this is important is because if supply has been brought back into the market, it has been dormant for 1 year and now has been brought back into the market, it's a really good indication. You can almost see this as almost like an implied volatility metric, that there's some volatility to come. So if you're expecting price movements because you are, for example, dollar cost averaging, this is a good indication that you might see a change in direction coming up pretty soon, as you've seen, with every single one of the times that this metric had these pretty violent spikes. There are other whale metrics that, or long-term holder metrics that are interesting to look at, that might be potentially more direct. So one good way of seeing how many whales are actually operating in a network is looking at the count of addresses holding funds above specific thresholds. So this section here showcases all of the metrics with all the critical thresholds that you would care about. If you think about, what is a whale, you can have a definition where a whale is an address that is holding a balance of over $1 million USD, right? So it's a coincidental metric that showcases, because there's price sensitivity in calculating that balance, right? It showcases how wealthy what is essentially the wealth of the participants in a network. And when it reaches these tops where the difference between the price increase, and looking at the slope of these, and there are several studies that you can combine these metrics with, but looking at the slope of increase of the two would be interesting, because you would see really a proxy for whale count, and more whales might entail less market volatility because they hold for longer. If that metric is going down, it tends to be a good indicator that there's a market contraction going, because a whale that might be institutional investor has unwound their own positions. One thing of note here on Vector is that all of our metrics, you're going to see native and you're going to see USD. This is Coinmetrics lingo, really. So USD means US dollar. So this metric showcases $1 million US. Native means the actual token units. right? So units
Ah,
of
interesting. Good to
BTC.
know. Hmm.
Yeah. So if you want to see, for example, uh, the other way around, right? If you want to see the address count holding very small percentages of the supply, there are metrics that enable you to do that as well. Like if you, for example, want to see all the addresses with a count of 0.001 BTC, which is more like a retail trader
Hmm.
indicator, it will
Right.
paint a completely different picture, right? You're going to see that over the last year, the number of addresses that were holding these smaller balances has increased drastically. Um,
Right.
it might be an indication that there's more retail investors that are entering the market, that might not be long-term holders.
Hmm.
So it can also be used as kind of a proxy for volatility. It might be used also to understand whether or not the network is being used as a payment instrument. But my interpretation is more like this is an interesting depiction of the prevalence of retail investors in Bitcoin. So
Very
um,
interesting.
these are some metrics. These four metrics are really good first starters for those of you that are getting into on-chain. There's a lot in unpacking what those metrics represent,
Hmm.
and you guys at Vector, you put together a really, really powerful way of contextualizing all this data with all these fun studies here. So if you're into technical analysis, it's really interesting to apply that to something that's fundamental, which is on-chain data, network data. And I applaud you guys at Vector for putting this interface together. But definitely recommend checking out these metrics. I think it's a pretty good indication or starting point for the more complex metrics that are offered by the platform.
So, looking at this chart, am I able to understand maybe some signals in regards to the behavior of market participants in terms of like directional change, whether reaching ups and downs in the market, depending on like how much a whale is putting in versus um, regular market participants?
Yeah, so you can see really the predominance of the types of users that are interacting
Hmm.
with the network, right? That's ultimately what you want to see, and you want to see, for and this metric is interesting for Bitcoin, is interesting for other networks as well. And the reason is you can kind of see what is the proportion of addresses that are whales relative to addresses that belong to everyday individuals, right? That just want to get some exposure to Bitcoin. So an interesting way of comparing this is, and it's interesting to keep this in native units. But let's say a whale is someone who holds at least 100 BTC, right?
Hmm.
Has a lot of BTC. So, and you want to compare that against this chart here, which is a retail investor type. Um, let's select the address count with a balance of 100, and you can
Hmm.
make those determinations, right? Um, there was a pretty considerable drop in it when there's like this short term volatility. I'm going to zoom out a little bit, but addresses that are holding at least 100 BTC dropped considerably earlier this year, which
Hmm.
might be an indication that whales are selling. If you're if the hypothesis is addresses above that holding at least 100 BTC are whales,
Hmm.
and this represents the count, um, a drop like this of kind of unprecedented violence it's a pretty good indication that whales might be cashing out. And you'd have seen this pretty drastic signal, at around these levels over here.
Mm-hmm.
So there are multiple, yeah, go ahead.
Sorry, I was going to say, would that basically mean that a bearish market would probably follow, or at least a temporary adjustment in the market?
Yeah, whales have a really strong impact in these markets. They are usually the ones that make those first violent price. They're usually the reason behind those initial like violent moves, right? So a proxy for whale count, which is this address count with holding up above 100 BTC. It's a pretty good indication of that, right? When it drops, when it has like these pretty severe drops, you could interpret it as a decrease in the number of whales. Why is there a decrease in the number of whales? Perhaps they liquidated those wallets, right? Perhaps a whale had, or multiple whales had, various wallets holding at least 100 BTC that were then deposited into exchanges or OTC desks or market makers, sold for cash basically, and those wallets disappear, right? The funds that were in those wallets are now at the exchange, and the exchange might have to liquidate those funds too if they're in excess of liquidity. So it's really interesting to kind of come up with these hypotheses and test them out. Ultimately, that's what we want to do, right? There are some metrics that have clear or clearer market direction than others. What we want to do is really give you all the data, give you the foundation of understanding what that data represents, and enabling you to create all these studies and fundamentally understand, which metrics fit your model on the basis of what is your investment time horizon, what's the size that you're operating under. But this is a pretty robust set of metrics to make those determinations, right? You might want to invest on the basis of exchange flows plus whale counts, and have like a multi-factor strategy, denoting what you ultimately do in the market.
Very, very good. Excellent. So definitely keeping these types of metrics in mind when placing trades, analyzing the different addresses, different wallet sizes you can do with on-chain data, and definitely beneficial to have a look at them prior to placing trades as a retail investor, for example, right?
Absolutely, yeah. These metrics are really interesting because it speaks to a bigger theme, which is the democratization of information, right? In traditional finance, if you want to get this level of intel on what other entities are doing, you have these high frequency funds that are paying millions of dollars for intel. What's really interesting about crypto is that you have this level of transparency, albeit it's difficult to actually pull that data yourself, but that's what we're here for. And you can actually get to an interesting set of insights and of indicators that you just really can't have in traditional finance. So it's a really interesting new paradigm for investors of really any size. And that information, the fact that it exists, opens up a whole new type of investment strategy and trading model, because you have like this new informational paradigm with on-chain. So it's very powerful, and we're really in the beginning of I think an on-chain revolution where more and more trades happening in these decentralized exchanges. The tooling around them becomes more sophisticated. The on-chain footprint as a result improves, and we'll have plenty of additional metrics to talk about as the industry progresses. So
that's excellent.
Pretty exciting times.
Bottom line, knowledge is power. Continue to learn as much as you can day by day, and I guess that's the way to go. Also,
Absolutely.
wanted to ask you if you have a few more minutes.
Yeah.
How have regulatory measures affected on-chain data?
Yeah, that's a great question. We've seen really interesting impacts on chain when it comes to regulation, right? So we broke news last year. I think we're the first ones to actually see this coming. That there was something happening in China with
Mm-hmm.
the miners that are operating in that country, and we
Mm-hmm.
actually used on-chain data to understand that something was brewing in China. The indicator that we used in that for that specific research is a very specific mining indicator. It's the flows that are going out of miner wallets,
Interesting.
which, for those of you using Vector, be on the lookout for that metric. I am pretty sure it's coming to you. But maybe we can do another live when that metric is on the platform. But
For sure.
we saw that miners were sending a lot of funds to third-party wallets. And miners, they play a big role in the short-term liquidity of a crypto asset. They usually have to plan for the long run. So if they're expecting volatility, they will start selling, and they have, the biggest miners, they have a pretty strong balance sheet to weather through the storms.
Mm-hmm.
And in the case of these Chinese regulations, they were really a crackdown on miners. It was a byproduct of a crackdown on corruption in China, and bottom line was miners wanted to move out because the entire supply chain had completely shifted in China as a result of these regulations. So that had a clear impact on chain, because hash rate was starting to drop. It hadn't reached bottom, but we
Mm-hmm.
saw that a lot of miners were moving funds. They were not moving to exchanges. They were moving what was likely OTC desks to provision liquidity, and
Interesting.
they're moving to other jurisdictions, to Mongolia and other Asian countries. Some miners, moving even continents, and
Wow.
to do any of that, you need a lot of short-term liquidity, and you do that by selling, right? So it was a really interesting indicator ahead of the CCP crackdown, and the prediction was correct. Hash rates, which is a proxy for how many miners are the resources that are being allocated to the network, dropped 50% after that, and so did prices
Wow.
as a result. So regulations have various impacts on chain activity. Be it from it really depends on the regulation and what is its ultimate impact. This specific piece of regulatory development impacted miners more than anyone else, miners based in China. But there
Mm-hmm.
are other regulatory moves here in the US or in various jurisdictions that might entail impact, right, on who's actually interacting with these networks. And if it's hash rate and the entities that are producing hash rates are unplugging and moving elsewhere because they have to, you can actually see that impact on chain. You can see, blocks taking a bit longer to be mined. You can see hash rate dropping, difficulty dropping, and it speaks to, this new paradigm of information. You can actually track that events live, and truly get to the bottom of it when it comes to infrastructure like Bitcoin, right? You can actually understand exactly what's happening and actually monitor its impact in real time, which is pretty cool.
That is very cool, actually. Yeah, I could only imagine, a big whale unplugging all their equipment and saying, "See ya, I'm moving to another continent." Probably took like a month before they set up shop
Yeah,
once more, and reappeared suddenly on the market once
yeah,
more.
yeah. The fact that you can see that coming it's really important, right? Because it's almost like something that you predict, and you understand what will be the impact if you're ahead of the curve when it comes to understanding that impact. And you're talking about, hey, hash rate will drop, but it's okay. Bitcoin pays for its security by orders of magnitude. The scenarios where that drop will actually entail an attack on Bitcoin are very slim, or the chances of that happening are very slim. So if you see that coming and you get ahead of even the media jumping into sensationalist headlines like hash rate drops 50%, and you can actually see, hey, this is likely going to have an impact on hash rate. And if it's within this band, within this threshold, it's actually okay. It becomes, a much more efficient market. If you get ahead of these trends, and you can kind of foresee how an event on chain will actually impact other metrics, it's a really powerful informational tool that you can use to your advantage. So still early stages, but incredibly exciting data sets to dive into.
Absolutely. So foresight is insight.
100%.
Very nice. One final question. So how have current global events affected on-chain data, if they have?
Yeah. So right now, we are really seeing the unwind of leverage in crypto. Right, crypto was there was a lot of leverage, especially in DeFi. Right, DeFi, a lot of these DeFi platforms enable you to attain leverage, and they don't react well to price volatility. When there's a lot of volatility in the market, a lot of loans get liquidated, and that has cascading impacts. So the worries in the U.S. about inflation, the increase in fuel prices has really impacted market sentiments. Inflation in the U.S., in Brazil, is incredibly high, right? And it's something that might push kind of the economic outlook to a more bearish scenario. And that obviously has had an impact on chain, right? You saw that the number of whales have gone down. Maybe whales have unwound their positions. If you look at obviously mvrv is a pretty big determinant of sentiment, and there's capitulation, which provides opportunities, right? If you have capital set aside to actually make use of these opportunities. So all of these have an impact on on-chain, because on-chain effectively represents the interactions between users and the sentiment of users. You don't know who these users are. Their addresses on-chain are pseudonyms. But on aggregate, you can get a pretty strong sense of how is everyone feeling. Are they bullish? Are they bearish? Are they potentially selling? Are they buying? And that obviously has had an impact on chain. If you see, for example, exchange deposits really had a massive uptick because of fears, concerns with everything that's happening. So everything is interconnected. If the humans that are interacting with these blockchains are reacting to global events, that certainly will have an impact on on-chain metrics, because ultimately that's what on-chain metrics do, right? They depict the actions of users on an aggregate basis and help you answer some questions about how are these users feeling, how are their positions doing, and having proxies for that for the entire network can be very useful for yourself to kind of position yourself. So everything is interconnected, because under the hood, these addresses are controlled by users that are, reading the news, that are, also sharing some of these concerns about the economy. So very interconnected in that sense.
That's awesome. Thank you so much for coming on to the show, Lucas. Glad to have you
Absolutely.
on. Looking forward to our next episode together. So thanks everyone for tuning into Crypto Hour. Don't forget to subscribe to our channel. Big thumbs up. Activate notifications to receive our latest episodes as they drop. And we'll see you all on the other side.